Hi everyone, it's your daily 10-minute business and finance news wrap from the SBS newsroom for this Thursday, the 22nd of September 2022. The Australian share market was closed because of the public holiday today, but there was a lot of action coming out of the US, which will have major ramifications for Australia. The US Federal Reserve, its central bank, lifted official interest rates there by 75 basis points overnight and warned that rates will peak higher than expected. What does this mean about the global economy, a potential recession, and for Australian interest rates and the dollar? For more, Marcus Megalokonomos spoke with Shane Oliver, the chief economist at AMP Capital.
There was no surprise in that the Fed raised interest rates by another 0.75%. That was largely what was factored in. But the big surprise for investors was the extent of the Fed's hawkishness. They've revised up their expectations for future rate hikes quite substantially, and the commentary in the statement and also from Fed Chair Powell was very, very hawkish. Basically, Powell is going to keep at it until he gets inflation back down to where he wants it to be. So no relief on the horizon, and obviously another rate hike. That all pushed the US share market down quite substantially at the close in the US.
What indication does it give us about future rate rises?
Well, the key message from the Fed is that they're going to keep going. And that was evident not only in the comments that Fed Chair Powell made at his press conference, where he was very, very hawkish, very adamant the Fed is going to do everything it can to get inflation back down to target. But it's also evident in what you call the Fed dot plot. And that's where all of the Fed officials are asked to put down their expectations for the key interest rate in the US, which is the Fed funds rate. And it was increased even further, above 4% by year end and going up again through next year. So we're looking at US interest rates on that basis, heading up to around 4.5% to 5% from their current levels, which are obviously just above 3%.
Is there an increased threat of a recession that we could potentially see next year?
Look, I'd have to say the risk of recession is very high now in the US. It was already pretty high. And the Fed isn't forecasting a recession, but it did downgrade its economic forecast yet again. It only sees 0.2% growth this calendar year, which is pretty close to a recession, and it downgraded its forecast for economic growth next year, and it also revised up its forecast for unemployment. So that suggests that while the Fed isn't forecasting a recession, the risk of recession has gone up dramatically. And you get the impression from the Fed that they are prepared to tolerate a recession if that's what's necessary to get inflation back to that 2% target.
And what does this mean for our Australian economy?
Well, for Australia, it's bad news. Obviously, if the Fed's continuing to raise interest rates, it still sees a big inflation problem in the US, then other central banks will be seeing the same, including the Reserve Bank in Australia. Now, I guess the good news is that the Reserve Bank recently has been prepared to take a more balanced approach. It's conscious of the lags involved in raising interest rates before it actually hits the economy, and it also wants to get inflation under control, but at the same time, try and protect jobs and economic growth as much as possible. So I think we do see more rate hikes ahead from the Reserve Bank in Australia, but I don't think the Reserve Bank is going to be as aggressive as the US central bank is. So right now, we've got a meeting coming up early in October from the Reserve Bank. We expect that they will raise rates again at that meeting, and that indeed has been signalled by the Reserve Bank itself. There's a debate as to whether they'll raise rates by 0.25% or 0.5%. We lean to the lower number, but it does look almost certain that the RBA will raise rates again. There are several reasons why the Reserve Bank can diverge from the US and not raise rates as much. Inflation in Australia is lower. Wages growth is about half what it is in the US. We've got about twice the amount of household debt for households than is evident in the US. And more Australians are on variable rates, which means that as the RBA raises rates, there's an almost instantaneous impact on household interest payments, whereas in the US, they've got 30-year fixed mortgage rates. And so the impact is far more drawn out. So for those reasons, I think the Reserve Bank can afford to be less hawkish than the Fed, but bottom line is rates in Australia will still be going up.
Shane Oliver there from AMP Capital speaking with Marcus Megalokonomos. Now, not everyone agrees with Shane in terms of how aggressive the Reserve Bank will be, especially next month, with some major implications for the Australian dollar as well. One of those is David Bassanese. He is the chief economist of Betashares, and I spoke with him earlier.
And I think the RBA would like to be reducing the size of the rate increases, but what we are seeing is that, you know, the Fed being so aggressive with raising rates, we're seeing the Aussie dollar weaken, for example, because the interest rate differential is widening in the favour of the United States, which makes the Aussie dollar, puts downward pressure on the Aussie, which then in turn puts upward pressure on imported prices. And so the last thing we want is further inflation coming through imported prices. So the RBA unfortunately can't allow itself to get too far behind the Fed. So on balance, not only the rate rise today, but the upward revision to what the Fed thinks it will need to do over the next 3 to 6 months has me thinking the RBA may well go by another 0.5% in October. I was thinking they may try to scale that back to 25, but again, given what we've seen overnight, I think they're probably, and given the weakness we're starting to see in the Aussie dollar, further weakness, they may decide to go by that larger amount again.
As you mentioned, though, that interest rate differential is increasing, even though the RBA may go by 50 now. The US is still at 75 basis points, so that the differential is increasing. Can you go into more detail about what you think that means for the Australian dollar and where you see it going? What kind of forecasts have you got?
Yeah, so the two problems for the Aussie dollar at the moment is the Fed are more aggressive in raising rates. So as you mentioned, the interest rate differential is widening in the favour of the US. So people that invest in markets, that means it's more attractive to put your money in the United States than in Australia. So you see capital flowing out of Australia into the US in a sort of general sense. So that downward pressure on the Aussie. The other thing is the Fed being so aggressive, it's reducing expectations for global growth. So a weaker global growth outlook, and I said potential US recession, is not great for commodity prices, and in turn not great for the Aussie. So I've got the Aussie going to say 62, 63 cents by year end at the moment. So I think the trend is going to remain weaker, notwithstanding the fact the RBA will be raising rates. And as I mentioned, that will flow through to higher imported inflation.
David Bassanese there from Betashares. This SBS on the Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any